Hey there, Investorholics. Welcome to another ETF Spotlight review. Today we'll be taking a look at SFY, which is the SPDR S&P ASX 50 Fund. It's brought to you by the fantastic people at State Street Global Advisors. SFY is the only ETF in Australia providing exposure to the ASX top 50 securities. State Street Global Advisors launched the ETF in 2001, pioneered exchange traded investing in Australia, so they were one of the first companies to bring ETFs to the Australian market. So stick around, guys, if you want to have a look at this alternative to, say, the S&P ASX 200 funds that we previously reviewed. So hang around, and I think it'll be worthwhile. Hey there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so that you can navigate the markets wherever you are. My mission here at KrackTheSky is to give you the knowledge and the confidence to take control of your personal finances, expand your investment horizons, and crack your financial sky. So don't be afraid to give me a thumbs up. And also subscribe. It helps get the message out there. It helps pump the algorithm for YouTube. Just in general, it sort of gives me a bit more motivation as well to keep doing these little reviews for you guys. Thanks. Okay, so investment objective, the SPDR S&P ASX 50 Fund seeks to closely track before fees and expenses returns of the S&P ASX 50 index. The benchmark, so the S&P ASX 50 index is Australia's most prominent large cap equity index and is designed to represent 50 of the largest and most liquid stocks listed on the ASX by float adjusted market capitalization. So it's the only ETF in Australia to provide exposure to the ASX 50 top securities, which we've touched on before. Y factor, so as always we're looking for diversification. So gain cost efficient exposure to 50 companies across all sectors, representing around 75% of the Australian equity market capitalization in a single trade. Capture capital growth, so capture growth potential in stock prices, opportunities offered by the Australian blue chip stocks. Effectively trying to capture the upside on those blue chip stocks. Also, with these ones, I suppose you're looking at income as well, because the majority of these top 50 will be paying a dividend. So capture income, potentially benefit from quarterly dividend payments and franking credits. So it might be something to keep in mind if you're looking for income, so passive income. So we had a net asset value of $63.35, trading just below that at $36.21, market cap of $743,200,000. Get me decimal points in the right spot. Management cost of 0.286%. The distribution is quarterly, so January, April, July, October. Dividend yield is about 3.85%. Obviously, dividend yield goes up and down associated with the share price. The fund portfolio exhibits significant concentration, obviously with only holding 50 stocks, and cyclical sectors dominate the portfolio. SFY is a sound option for investors seeking low-cost access to a portfolio of large Australian companies with significant exposure to the financial sector. As always, we're looking for what are the options. I mean, it might be a good option, but is it the best option? We always have a look at some other things. So during your research, check out ZYAU and ILC. Just a quick overview of what we're holding here. So financial services constitute almost a third of the overall portfolio, while basic materials accounts for about 16%. That was sort of late this month when I quickly did the research. September 21 is also top heavy, with roughly 37% of the index in just 5 companies, so that's something to keep in mind. Earnings from Australian companies are home based, with the large banks, supermarkets, telecommunications providers largely generating their earnings domestically. Historically, SFY has delivered an attractive yield and franking credits, increasing its appeal from post-tax standpoint. Yeah, so let's have a quick look now at the graph. Okay, so your top 10 holdings: Commonwealth Bank, CSL, BHP, Westpac, NAB, ANZ, Wesfarmers, Macquarie, Woolworths and Telstra. Performance over the 5 years up to about 10%, so you're hoping for about 10% if you can. So since inception, 8%. That's when you add up your distribution, so your dividends plus the growth in the share price over time. So 8%, is it world beating? Probably not, but it's about kind of what you'd expect especially from a majority of what you call blue chip shares anyway. So I mean, that means they're definitely mature businesses. The concentration level of the fund makes it susceptible to higher volatility. They're heavily allocated to cyclical sensitivity sectors, shows a dependence of the Australian share market on economic activity. Post COVID-19, SFY has attained its previous highs. I haven't put the graph in here, but if you go and look at the graph, you can see that sort of met and passed the COVID-19 highs now, or pre-COVID-19 highs, I should say. SSGA has shown more discipline around product development, purging questionable funds and building a suite of sensible, constructed, low-cost core exchange-traded funds. So State Street Global continues to cut expense ratios in the US, and hopefully, those things follow on. Because the lower fees you pay, the higher the return for investors. So Morningstar gives this fund a bronze rating. I mean, I've had a look at STY, which is the State Street Global ASX 200 fund. I've done a video on that one as well. So you actually get a better return from that fund than you do from this. So I'd be having a look at that and sort of thinking to yourself, is it actually worth buying something that's more concentrated and getting a lower return over time than the S&P ASX 200 fund? Or alternatively, what you can do is just buy the top 5 out of the top 5 holdings in this fund, because I'm pretty sure that they'll be the same as STW and SFY, and then you're probably going to get a similar return from those top 5, considering the fact that they make up such a large percentage of the index. But as always, you need to be sitting down and doing your own research. These are just some ideas. Would I bother buying it? I thought it was an interesting idea when I first decided to review it, but as I kind of just mentioned, then once I compare STW to SFY, and I'm sure the IVV and A200 and VAS are going to be a similar situation. I think they're going to have a better return overall than the this fund, which is slightly more concentrated. So definitely have a look at all those other options. I'd say no for me. If I was going to look at this fund, I'd just buy the top 5 holdings in this fund and just forget about it. Just build those and forget about everything else, because returns can be probably similar. Anyway, that's it for today. Thank you very much for hanging around to the end. Hopefully added value, and have a good night. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's Crack the Sky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.